expenses,
5.
we call it
Should be question number 5.
expenses. We call it
Yes, I hope you're
expenses.
there. So if
Or
you
what
have
we
the
call
question with
of
you,
the
please
business.
confirm.
Expenses
Please
of business.
confirm. If you have the question with you,
So we did say
please
on expenses
confirm.
of the business for tax purpose, the basically two
Okay.
expenses.
So what are we
have
told
what we call
in this
allowable,
question here? So we are told the foreign trial balance needed to be delimited as at
we
31st
have
of
what
December
expenses,
2022.
and we have
So we are given
what we call
property at costs, and we are told
allowable.
included within that properties are
Call it the
building whose cost is 400,000. We have the front end cost.
We
Motor
have
vehicle
what we call
cost,
allowable
office
expenses,
equipment and
and then
cost.
we
We have
have
accumulated
what we call the
depreciation for building,
non-allowable
plant,
expenses. So we start with
motor
allowable
vehicle,
expenses.
office equipment.
We start
Then we have
with
inventory on 1st January
what we call
2022
allowable
purchases at cost,
expenses.
distribution cost,
We start with what we call
administrative
the allowable
expenses,
expenses.
revenue, trade
So when you talk
receivables,
about
and trade
allowable
payables,
expenses,
bank balance, deferred tax,
we say
current tax,
these are
and the bank
expenses of the business.
interest.
We say
Then
these
we
are
have the ordinary
expenses
share capital
of the
share
business,
premium, retained
which
profit on
can be
1st January
deducted
2022,
against
interim
a
dividends which were
taxable
paid, and then
income.
we have the
So we
suspense
say our
account.
expenses
Then we have some additional information
are
number 1 all the way to note number 6.
expenses.
And then what are we required to do? We are required to prepare the following
expenses
financial
of what they
statement
call the business.
presented in a suitable format for
The
publication.
business
Number
that can be
1,
deducted,
we are required to prepare the statement of profit or loss
that can be
for the year
deducted.
which
We
ended
say that can be
31st of December
deducted.
2022.
We say
Roman 2
against
statement of changes in equity
against
for the
what
year
we call
which ended 31st
a
of December
taxable
2022.
against
And
what we
Roman
call
part C,
taxable
we are required to prepare
income.
the statement
So these are
of
basically expenses
financial
of the business that can
position.
be
So
deducted
before we
against the
prepare what is
taxable
required here, I
income.
want us to go through the
So
additional
step number
information.
1,
We see whether
we
there are
call
some
it
workings
all
which
revenue.
are required. We do those
We call
workings
it
and
all
we
revenue.
finally prepare what the examiner was
And
required.
what we
So
call
therefore, we will
commercial
start by having some workings.
and commercial
And this
expenses.
is as per the additional information.
All
So
what
let's
we
go
call
to the additional
all the
information number
revenue
1. You see what we are told.
and what we call the commercial
Additional information
expenses.
number 1, we are told
All
what?
revenue and
What are we
commercial
told in the additional
expenses
information number 1?
So when you talk about
In the
revenue
additional
and commercial
information number
expenses,
1,
we are basically saying that when you talk about revenue expenses,
what are we told there?
are expenses
We are
that
told
are
during the year
business
which
incurring
ended
the current
31st
year,
of December 2022,
and the benefits are
which is
fully realized.
automatically the
When you talk
current year,
about
be
the revenue
delimited
expenses,
and disposed
we
of an
say that
item
the
of funds
expenses are
for a
expenses of
cash
the current
proceeds
year,
of 20 million,
and the
which has been
benefit
credited in the
is
revenue
basically realized
account.
fully
No other
in the
accounting
current
entries was
year.
made.
Are we
The
together?
plant had
So the benefit
a
of these
cost of
expenses do not extend
39.7 million
beyond
and
what
accumulated
we call the
depreciation
current
of
year. Together, team.
15.86
The benefits
million.
of
So we are
what we
told
call
any
the
gain or
revenue
loss on
expense
disposal of
do
the
not
plant should be
extend
included
beyond
within the cost
what
of
we call the current
sales.
year.
And then you're
Do
told
not
it is the
extend
policy of the
beyond the
company
current
to
year. Thank you,
provide
Japan.
a full year
When you talk
depreciation
about
in the
commercial
year
expenses
of the
altogether,
asset purchase
these
and
are
none in the
expenses
year of
that are basically
disposal.
incurred
So
when you
in
talk
that
about
case,
commercial
we're given information about
that
an
are
asset which
incurred
was disposed.
to
And
help in
there are
generation
two,
of what we
I
call the
think, two
taxable
adjustments we're
business
going to make in
income.
relation to that.
When you talk
Because
about
we are told
commercial
that
expense,
this item of
we
plant
understand that
was
these
sold
expenses
for
are
20
basically
million. Now, this
incurred
20 million,
to
we are
raise
told
what?
is
The taxable
included
business
within the revenue.
income.
So it is
revenue
obvious
and
that once
commercial
the company
expenses,
sell an asset,
they basically include.
the amount
When you
received
talk
from
about
the sale
revenue
of
and commercial
assets, this
expense,
should
we say
not
they
be
include
treated as part of the
what we
revenue.
call the
Should not be
business
treated as
rent
part of what?
expense.
Of the sales. And therefore,
We have what we
this
call the
amount of
business
20 million,
rent
this
expenses.
amount of 20
We
million,
have what we call the
which
business
was
rent
received from
expenses.
the disposal
Business
of
rent
the plant,
expenses. We have business, what we
20
call the
million.
business.
This one will be deducted from the revenue.
Electricity.
This one will be
We call it
deducted
the
from the
business
company's what?
electricity expenses.
Revenue. Because you are told this 20
Business
million
electricity
was
expenses. We
included
have
within
what
the
we call
revenue. It was credited in the
business
revenue
salaries
account.
and wages.
It's also important for you to note, if you go to the requirement, to the
salaries and wages. Business salaries and wages. And you can talk about business stationaries. So these are commercial and revenue expenses. Business stationery. I think this is expounded perfectly. Is everybody at par with Molimo? Are we at par with Molimo? So those are revenue and commercial expenses. So that is the first allowable expense. And you say allowable to mean that we can deduct them against a taxable income. Perfect. So then we go to the second. We say trade bad debts written off. The second is what we call trade. We call it the trade bad debt. Bad debt, we say written off. What do you call the trade bad debts written off? What is a trade bad debt? There's what we call non-trade bad debts altogether. When you have bad debts that basically relate to fixed asset or non-current asset, those ones are what we call non-trade bad debts altogether. So the trade bad debts that are written off altogether are basically allowable expense. When somebody took goods and they are not able to pay, those are basically what we call the trade bad debts. So the trade bad debts, to say in taxation, are allowable expenses, meaning that we can deduct them against a taxable expense. However, for non-trade, we basically need to understand that non-trade bad debt, we say are what we call are non-allowable. These are basically non-allowable expenses. So for the non-trade bad debts, these are basically non-allowable expenses. So examples of the non-trade bad debts, examples of what we call the non-trade bad debts, debt resulting from selling, we say non-trade bad debts that result from selling. We have what we call selling of what we call fixed assets. So debt that results as a result of selling of fixed asset, that is non-trade bad debts, and that is non-allowable. We can talk about lending to customers, what we call lending to what we call customers. We have friends, we have employees, etc. Those are basically what we call non-trade bad debt, non-trade bad debt. When you sell fixed asset on credit and they refuse to pay, that's a non-trade bad debt. Unless those fixed assets are stock. Together, team, we respond with a yes. So that is number 2. Trade bad debts is allowable, but non-trade, these are non-trade, this should be non-allowable. We respond with a yes if you're together. Are we together? Are we together? Respond with a yes if you're together. Are we together? Is there anywhere that you need clarification? Are we together? Perfect. Thank you, Zipporah. So then we get to number 3. We call it specific. Number 3, we call it specific. We basically call it specific provision. We call it specific provision.
Yes. So
for bad debt. For bad debt. What you call specific provision for what you call the bad debt. Remember, in accounting, the general provision is allowable. However, in tax, we say specific provision for bad debt. And we have to be very specific. We say increase. In this case, this should be increase. Increase in what we call specific provision for what we call for bad debt. Increase in what we call specific provision for bad debt. That is allowable expense. Increase in what we call specific provision for bad debt. That is allowable expense altogether. So there's a difference between what we call specific provision.
So if you are here, please confirm. If you have that paper with you, if you have that question with you, please confirm. If you have that question with you, please confirm. Balances, account payable, account receivable, repair and maintenance, general expenses, insurance carried in budget return of salary and wages, office expenses, provision for depreciation on furniture on 1st May 2015. We have cash balances, we have drawings for Maria and Bakari. Then we have additional information, number 1 up to number 6. And from that information, what are we required to do? We are required to prepare the income statement for the year which ended 30th April 2016, 12 months. And also we are required to prepare the statement of financial position as at 30th of April 2016. So automatically, even before we prepare what is required, we must first of all go through the additional information we see. Is there any working which is required? So therefore, we go through the additional information as we check whether there is any working which we need to do. So in note number 1, additional information number 1, I hope you are there. I hope you are there. We are told inventory as at 30th of April 2016 was valued at 15.6. No working for that. That is a closing inventory. Number 2, we are told depreciation is to be provided for as follows: building 2.5% on cost and furniture 10% per annum on reducing balance. So we need to compute those depreciation. So our first working here would be to compute the depreciation. And in this case, we start by computing the depreciation on buildings. The depreciation on buildings in this case would be 2.5%. Which method? Or basically, we are told per 2.5% per annum on cost. What is the cost of buildings? So if we go back to the trial balance, up there we have capital, current account, inventory, and then below that we have the cost of buildings, which is 8,500. I hope you can see that being the cost of the building. But down the building, I hope you can also see we have furniture, and then I hope you can also we have something called the renovation of a building. So a renovation of a building, basically, this is a cost which is incurred by the company in renovating a building. So how do we account for that renovation cost? Now, this renovation cost, this one is supposed to be capitalized. This one is supposed to be what? Is supposed to be capitalized. So what do you mean by capitalizing an expense or capitalizing a cost? So this renovation cost will be considered to be part of the cost of the building. So if you have renovated a building, so the cost you have incurred, you should add it to the cost of your buildings. You should add it to the cost of your building. But this one, renovation cost, this one should not be recognized as an expense in the income statement. In other terms, a renovation cost, this is a capital expenditure. These are capital what? Expenditure. I don't know whether we discussed this when we were looking on the earlier adjustment, but I think I mentioned something to do with that. There are those particular expenses which are incurred by the company and which are not supposed to be taken to the income statement, but rather they are supposed to be capitalized. A good example is the renovation cost. This one should not be taken to the income statement as an expense, but this one should be considered as part of the asset. So therefore, to determine the cost of the buildings, we will take the cost which are given below the inventory at the start, which is 85, and then now to this we add the renovation cost. The renovation cost, which is 1,500. So meaning that the cost of the building will be 10,000. Will be 10,000. So this renovation cost will be added to the cost of the building. Will be added to the cost of what? Of the building. Is that clear? Is that clear? Is that clear, Evans? So once you have renovated a building, because these are costs you're incurring once, you add it to the cost of the building. You can't take that to the income statement. So the expenses which we take to the income statement are the expenses connected with the operation of the business. Once we renovate a building, this is not an expense connected with the running of the business. This is not like electricity. This is not like salaries. This is an expense which just incurred once. You add it to the cost of the building. So therefore, this one would be 10,000. And basically, this will give us what? This will give us 25. It will give us 25. Is that coming to 2,500? Please confirm 2,500. Are you getting 2,500? 2,500? 2,500? Yes, 2,500. So then from there we move and compute depreciation for the other asset, which is the furniture. furniture will be equal to 10%. The method which is used here is the reducing balance. The reducing balance, we compute the depreciation. We compute the depreciation based on the net book value. What will be the net book value for furniture? The net book value, remember, is equal to the cost minus the accumulated depreciation. So the cost of furniture, which is below our buildings, is 32, and then still within the trial balance down there, down in the trial balance, we have something called the provision for depreciation. So that provision for depreciation on furniture, this is another name for accumulated depreciation. So the accumulated depreciation can also be known as what? Provision for depreciation. So therefore, the accumulated depreciation on furniture is 750. So we get the net book value, and then we get 10%. So this will give us what? 32 minus 750, which will give us 245. Okay, so we are done with that. And then number 3, we are told the following amounts were owing as at 30th of April 2016. We have salaries and wages and electricity. I think we don't need to have any working for this. Remember, you said any expense which is outstanding or any expense which is owing is an expense not yet paid at the end of the year. This one, we said 1, we add it to the expense already paid, and number 2, we account for it as a current liability. We account for that as a current liability. I'm told this one is 250. I'm told that one is 250. Okay, that one is 250. So therefore, no working which is required as far as number 3 is concerned. So those expenses which were owing, we add them to the expenses already paid, to the expenses in the trial balance, and then we treat them as a current liability. Number 4, allowance for doubtful debts amounting to 200,000 is to be made. So what we need to do here is basically to determine whether we have an increase or decrease in allowance for doubtful debts. Which we list here should be the drawings for goods which are given as part of the additional information. So these drawings of goods given in the additional information, they have not yet been accounted for, not the drawings within the trial balance. If the drawings in the trial balance were drawings for goods, they have already been deducted from the purchases figure. But what you list here are the drawings for goods given in the additional information. Are we together? Yes, that one you must understand it. You must understand that. So the drawings for goods, we have said is 150 plus this one, which will give us 740. So we list that here. We list that there. And basically now we will get the goods available for what? For sale. We will get the goods available for sale. We will get the goods available for sale. So how much will be our goods available for sale here? What are you getting? 25 units. If Marimu's computation is automatically not correct. Not correct. Yes, what are you getting, guys? What are you getting? We try to hurry up. We must finish this particular question today. 83, 160. 83, 160. So to this, then we proceed. We left the crossing inventory. So the crossing inventory, this one, is given in the additional information number 1. Additional information number 1, 15,600. 15,600, yes. So let's get the cost of sales, which we can take now to the last column. I'm getting 65,760. Is that what you're getting? Is that what you're getting? Is that what you're getting? Yes. So and then we get the gross profit. We get the gross profit. So the gross profit in our case here will be, I'm getting 21,700. 21,700. That is the figure I'm getting from 𝐎𝐍𝐹. That is the figure I'm getting from 𝐎𝐍𝐹. That is the figure I'm getting from 𝐎𝐍𝐹. Okay. So to this, we proceed, we add other incomes. We add other incomes. So we need to go back to the trial balance. We see, do we have any other income? And remember, in this case, we said when checking for the other incomes, we check the items on the credit side of the trial balance. That's what you have to recall. So on the credit side of the trial balance, up there, you can see we have capital current, partners capital account, current account. Those are not incomes. Then down there, you can see we have sales. I can see we have bank balance, account payable. Down there, I can see we have accumulated depreciation. It basically means that in our case here, we don't have any other income. We don't have any other income. So we proceed. We get the total incomes, which remain the same as the gross profit. So then to this, we proceed. We less the expenses. We less the expenses. The expenses. Remember here we said when deducting the expenses, we always start with the expenses affected by the additional information. Affected by the additional information. Can we first of all go to the additional information? In the additional information, number one is all about the closing inventory. That is not an expense. Number two, we have these two depreciations. We have depreciation on buildings. Depreciation on buildings, which is 250. We also have depreciation on furniture. Depreciation on furniture, which is 245. So 245. So I've written what? I've written, oh, this one should be, you have written 83 instead of 81. This one should be 81,360. That's what I'm told by, yes, I think that one is correct. Okay, thank you, Purity. Okay, so let's move. We are done with additional information number 2. Additional information number 3, it affects 2 expenses. We are told the following expenses were owing, were not yet paid. So we start with the first one, which are salaries and wages. So salaries and wages, we will take the amount from the trial balance, the amount which was reported by the partnership business will basically be distributed to partners. Will be distributed to partners, or in other terms, how that particular profit for the year will be shared among partners, So therefore, to prepare this, we start with the revenue, just like what we are doing in case of sole proprietorship, in case of a company. Revenue is also known as the sales. And to this, we less the sales return. The sales return, which we also know is known as the return inwards. And basically, we get the net sales. We get the net sales. And then to this, we less the cost of sales. So the computation of the cost of sales remain the same. I hope you can be able to recall how we were computing this. We were taking the opening inventory plus purchases minus return outwards plus carriage inwards, minus the closing inventory. The computation of that is the same, just like what we're doing in case of partnership, in case of a company, and also in case of a sole proprietorship. So then from there we get the gross profit, profit. So after getting this gross profit, we basically proceed and we add the other incomes. We proceed and we add other incomes. We add other incomes. So the other incomes to be added here include things like discount received, the rent received, the decrease in provision or allowance for doubtful debt, and so on. And then we get the total incomes, the total incomes, and then to this we proceed and we less the expenses, just the normal expenses, things like depreciation of assets, the salaries, and things like the rent and electricity, and so on and so on. The normal expenses, we let them here, and basically we get now the profit for the year. The profit for the year. So after getting this particular profit for the year, in case of a partnership business, we proceed and prepare something called the appropriation account. Appropriation account, this one is prepared basically to show how this profit will be distributed, will be shared among partners. Because we have said a partnership business basically is formed with an objective of making profit and sharing out that profit. So any profit reported in a partnership business is basically supposed to be shared among who? A partner. So therefore, to this profit for the year, we first of all add something called the interest on drawings. Interest on drawings. So assuming we have a partnership business with 2 partners, so we have to compute the interest on drawings. The interest on drawings for each partner. So first of all, what are drawings? Drawings basically we know from the topic of sole proprietorship. This whereby you go to your own business as for example the owner of the business, you take some cash or even you take some goods for your personal use. So therefore drawings, this refers to the cash, or basically refers now to the goods taken by the partners from the partnership business for their personal use. So in most of the cases, the partners will have agreed that if you go to the partnership business, you take some cash, you take some goods for your personal use, you'll be charged an interest. So that interest should be added to this particular profit before it is shared among partners. So therefore, the interest on drawings, we add it there, and basically we get the total amount. This is the amount to be shared among partners. So how is this particular amount shared? So once we have gotten this particular total there, we proceed and we less appropriations. We proceed and we less what? Appropriations. So what do we mean by appropriations? Appropriations, basically, this refers to the amount of money which the partners are entitled to from the partnership business. For example, being a partner, you may be entitled to something like a salary from the partnership business. You may be entitled to something like interest on your capital. The capital which you have invested, you may be entitled to some interest on it. You may also be entitled to things like a commission from the partnership business. You may also be entitled to something like share of profit. So all these are amounts which you're entitled to as a partner from the partnership business. So therefore, here we list things like the interest on capital. In this case, we compute the interest on capital for each partner. Assuming in our case, we have 2 partners, partner A and partner B. So we compute this. Basically, we get the total, we take it to the last column. So we also have things like the commissions stroke salary to partners, stroke salary to partners. So we compute the commission stroke salary to our partners. And basically, we take that now to the last column. The other item we may have here is what? Is the share of profit, or basically the share of loss, equally for the 2 partners, the share of profit or the share of what? Of loss. And basically, once we deduct these 3 items, these 3 items should be deducted from this. And here, always we should get a 0, because this amount here must be distributed to partners in form of interest on capital, in form of salary or commissions, and also in form of what? The share of profit or loss. So therefore, you can see there is a slight difference in terms of how we prepare this statement of profit or loss in a partnership business with what we are doing in case of sole proprietorship, and also what we are doing in case of what? Of a company. So therefore, that's basically how we prepare this one. After preparing this statement of profit or loss, we basically proceed and prepare the other two final accounts which I've mentioned, the partner's capital account and the partner's current account. So what do we record in those two accounts? I want us to start by looking on how we prepare the partner's capital account, the partner's capital account, partner's capital account. Now, this account basically is prepared to record the capital which was contributed by the partners plus any additional capital. Any capital contributed by the partners plus any additional capital which is introduced. Now, this is basically a ledger account, meaning that this will be the debit side, this will be the credit side, and then on each side, we have the details column, and basically columns equal to the partners. Assuming in our case we have two partners, we have the details column, and assuming we have two partners, partner A and partner B. The same case on the credit side, the details column, and basically columns equal to the number of partners. So what do we record in this account? We record on this side the capital contributed. The capital contributed. So the capital contributed by partners, what is the double entry for that? That capital will be debited in the bank account of the partnership, and then credited in this account. Then also in this account, we also record any additional capital introduced. Any additional capital introduced. Any additional capital which has been introduced. Any additional capital which has been introduced. So these are basically the two main items which you record in this account. And therefore, this particular account or the balance in this account remain the same unless the partners have introduced additional capital. So if the partners just brought some capital when they were starting the business, they have not introduced any additional capital, the balance in this account will remain the same. But basically, I've said for those who are doing CPA foundation level, in this topic, you're going to look on how we account for the retirement, admission of a partner, and the dissolution of partnership. So in that case, when accounting for the retirement, the admission of a new partner, and maybe the other changes taking place in a partnership business and the dissolution, there are other items we will be recording here. But basically, we'll be able to introduce those items when looking on now how we account for the admission and also the retirement. Because I've said, like for those who are doing just ATD1 and CAMS1, you just need to know how to prepare this account by recording the capital introduced plus any additional capital. And then from there, we balance this account. So the balance carried down is always on this side. And this one will be taken to the statement of financial position, because this capital contributed by partners, it will be taken to the statement of financial position. So then from there, we have the other account, which is prepared in a partnership business, and that is the partner's current account. The partner's current account. So for the partner's current account, this basically is an account which records the amount of money which the partners are entitled to from the partnership business, and any amount of money which the partners are demanded by the partnership business. And therefore, all these particular appropriations, interest on capital, the commission, the salary to partners, the share of profit or loss, including the interest on drawings, all of them we record them in this particular account. And equally for this particular account, we prepare it using the T format, just like the current account, just like the current, just like the capital account, just like the capital account. On this side, remember this is the debit side, is the debit side. So we have the details column, and basically columns equal to the number of partners, assuming you have two partners like that, a partner A and basically partner B, partner A and partner B. So always we start with the opening balance. So the opening balance in this account can either be a credit balance. If it is a credit balance, the opening balance will be recorded on that side, or this account may have a debit balance, like assuming the current account of B has a debit balance like that. So then on this side, what do we record? On this side, we record the amount which the partners are expecting or basically are demanding or are entitled to from the partnership business. Those items include one, the interest on capital. The interest on capital. We also record things like the commissions or basically salary to partners. We also record the share of profit. The share of profit, we record it on that side. And then on this side, the debit side, we record those or any amount which the partnership business is demanding from the partners. The partnership business is demanding from the partners. So those items include things like the drawings. This where, as a partner, you have gone to the partnership business, you have taken some goods for your personal use or some cash for your personal use. So that should be debited here. Also things like the interest on drawings, and also the share of loss. And then from there, what we do, we balance this particular account. We balance this account. So this account can have a balancing figure on this side, on that side. So we assume the current account of A has a balancing figure on that side, and the current account for the other partner has a balancing figure on the debit what? On the debit side. So these are basically the items which we record in this account. There is something I've forgotten here, and that is something called the interest on loan. The interest on loan. If, for example, a partner has given a loan to the partnership business, so that partner may be entitled to interest on that loan. So that interest which is paid to a partner who has given a loan to the partnership business, that interest should be recorded here. So this basically how we prepare this particular account, the partner's current what? The partner's current account. And then from there we have finally we have the statement of financial position. And basically statement of financial position, this one is more the same, or this one is prepared in the same way, just like how we are preparing the statement of financial position of a sole proprietor, of a sole trader, and basically that of a company. So the only difference is where we record capital. So that's where we have the difference. So mean that this one is prepared in the same way, just like the statement of financial position of a company, that of the sole trader. But we have to remember that a statement of financial position, one, this one is prepared to determine the financial position of the partnership business at the end of the year. Number two, we prepare this based on the accounting equation. I hope you can be able to recall that the accounting equation, this one states that assets are equal to the capital plus what? Liabilities are equal to capital plus what? Liability. So here we always start by recording assets, which basically we classify into two, non-current assets and current what? Asset. So here there is no difference between what we are doing in case of a company and what we did in the topic of sole proprietorship. No difference. And then from there we get what? We get the total asset. We get the total asset. Then from there, we proceed and record capital. So in case of a partnership business, for the capital here, we record the balance from the partner's capital account. So these particular balances from this partner's capital account is basically what we bring here. We bring here also, here we record the balances from the partner's current account. From the partner's current account. These balances, the balances we get from these accounts, they are also reflected here. They are also reflected here. And this particular balance, which we bring here from this account, can either be positive or negative. So if a current account of a partner has a credit balance like this one, it has a credit balance. This one, we record it here as a positive figure. We record it here as a positive figure. But if the current account of a partner has a debit balance like this one, this particular amount, we bring it here as a negative figure. So that is basically a debit balance here. So that is very, very important that if the current account of a partner has a credit balance, record it here as a positive. If the current account of a partner has a debit balance, you record it here as what? As a negative. Then you get the total. Then from there, we proceed record liabilities. So for the liabilities, the only non-current liability a partnership business may have is a bank loan. So a partnership business may not have debentures or things like those. So then finally, we record the current liabilities. Current liabilities are the normal one: the bank overdraft, the trade payables, the accrued expenses, the normal current liabilities. And then from there, we get what? We get the total capital and what? And liabilities. The total capital and liabilities. And basically, whatever you get here, this one should be the same with the total asset. With the total what? Asset. So therefore, this is basically how we prepare the final account of a partnership business, So I've said those who are doing 𝐉𝐻1 and 𝐻𝐍1, mostly these are the questions likely to come across. But those who are doing CPA and 𝐻𝐍2, you may come across questions for admission of a partner, retirement of a partner, or basically the dissolution of a partnership business. So what I want us to do, we first of all do a question on this. And then what I'll be able to do, I will release those who are doing 𝐻𝐍1 and basically 𝐉𝐻. You will not be attending our subsequent class because we will be doing something to do with accounting for admission, which I'm saying is not within your syllabus. So I want us to start with basically a simple question from CPA. And that is a question from the sitting of May 2016. May 2016. Can we go to that question, May 2016? May 2016. May 2016. So you go to your past papers. Specifically, you go to that question there. May 2016. May 2016. May 2016, which is question number 2. So once you get the question, please confirm. And basically, I've said this is from CPA, from the paper for CPA. So I say those who are doing 𝐻𝐸D, no need to worry. Once we are done with the syllabus, we will be able to do a lot of revision using your past papers. Faster? Yes, using your past papers. No need to worry. No need to worry that we are using the CPA past papers. No need to worry. We will be able to use your past papers basically to do our revision. And for example, those who are doing 𝐻𝐸D1, we're almost done with the syllabus. We are almost done. We're almost done. And once we are through, we basically start the revision. So if you are there, please confirm if you have that paper with you. If you have that question with you, please confirm. If you have that question with you, please confirm. Paul is having it. Okay. Yes, the question is for Maria and Bakari. 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 I hope everyone is there. Okay, so what are we told here? What are we told? The question is, Maria and Bakari are in partnership, sharing profit and losses in the ratio of 3 all over 5 for Maria and 2 all over 5 for Bakari. The partnership did provide for the interest on capital at the rate of 5% per annum. The partners are entitled to annual salaries of 1 million and 700,000 for Maria and Bakari respectively. The following balances were extracted from the books. We are told the following balances were extracted from the books of partnership as at 30th of April 2016. So we have the capital account, the current account, inventory as at 1st May 2015, buildings at cost, furniture at cost, renovation of building, sales, purchases. And then we have rent and rates. We have electricity, we have bank balances, account payable, account receivable, repair and maintenance, general expenses, insurance carried inwards, budget written off, salary and wages, office expenses, provision for depreciation on furniture on 1st May 2015. We have cash balances, we have drawings for Maria and Bakari. Then we have additional information number 1 up to number 6. And from that information, what are we required to do? We are required to prepare the income statement for the year which ended 30th April 2016, 12 months. And also we are required to prepare the statement of financial position as at 30th of April 2016. So automatically, even before we prepare what is required, we must, first of all, go through the additional information we see. Is there any working which is required? So therefore, we go through the additional information as we check whether there is any working which we need to do. So in note number 1, additional information number 1, I hope you are there. I hope you are there. We are told inventory as at 30th of April 2016 was valued at 15.6. No working for that. That is a closing inventory. Number 2, we are told depreciation is to be provided for as follows. Building 2.5% on cost and furniture 10% per annum on reducing balance. So we need to compute those depreciation. So our first working here would be to compute the depreciation. And in this case, we start by computing the depreciation on buildings. The depreciation on buildings in this case would be 2.5%. Which method? Or basically, we are told per 2.5% per annum on cost. What is the cost of buildings? So if we go back to the trial balance, up there we have capital, current account, inventory, and then below that we have the cost of buildings, which is 8,500. I hope you can see that being the cost of the building, but down the building, I hope you can also see we have furniture, and then I hope you can also we have something called the renovation of a building. So a renovation of a building, basically, this is a cost which is incurred by the company in renovating a building. So how do we account for that renovation cost? Now, this renovation cost, this one is supposed to be capitalized. This one is supposed to be what? It's supposed to be capitalized. So what do you mean by capitalizing an expense or capitalizing a cost? So this renovation cost will be considered to be part of the cost of the building. So if you have renovated a building, so the cost you have incurred, you should add it to the cost of your buildings. You should add it to the cost of your building. But this one, renovation cost, this one should not be recognized as an expense in the income statement. In other terms, renovation cost, this is a capital expenditure. These are capital what? Expenditure. I don't know whether we discussed this when we were looking on the earlier adjustment, but I think I mentioned something to do with that. There are those particular expenses which are incurred by the company and which are not supposed to be taken to the income statement, but rather they are supposed to be capitalized. A good example is the renovation cost. This one should not be taken to the income statement as an expense, but this one should be considered as part of the asset. So therefore, to determine the cost of the buildings, we will take the cost which you are given and below the inventory at the start, which is 85. And then now to this, we add the renovation cost. The renovation cost, which is 1,500. So meaning that the cost of the building will be 10,000. Will be 10 what? 1,000. So this renovation cost will be added to the cost of the building. Will be added to the cost of what? Of the building. Is that clear? Is that clear? Is that clear, Evans? So once you have renovated a building, because these are costs you're incurring once, you add it to the cost of the building. You can't take that to the income statement. So the expenses which we take to the income statement are the expenses connected with the operation of the business. Once we renovate a building, this is not an expense connected with the running of the business. This is not like electricity. This is not like salaries. This is an expense which just incurred once. You add it to the cost of the building. So therefore, this one would be 10,000. And basically, this will give us what? This will give us 25. It will give us 25. Is that coming to 2,500? Please confirm 2,500. Are you getting 2,500? 2,500? 2,500? Yes, 2,500. So then from there we move and compute depreciation for the other asset, which is the furniture. Furniture will be equal to 10%. The method which is used here is the reducing balance. The reducing balance, we compute the depreciation. We compute the depreciation based on the net book value. What will be the net book value for furniture? The net book value, remember, is equal to the cost minus the accumulated depreciation. So the cost of furniture, which is below our buildings, is 32, and then still within the trial balance down there, down in the trial balance, we have something called the provision for depreciation. So that provision for depreciation on furniture, this is another name for accumulated depreciation. So the accumulated depreciation can also be known as what? Provision for depreciation. So therefore, the accumulated depreciation on furniture is 750. So we get the net book value, and then we get 10%. So this will give us what? 32 minus 750, which will give us 245. Okay, so we are done with that. And then number 3, we are told the following amounts were owing as at 30th of April 2016. We have salaries and wages and electricity. I think we don't need to have any working for this. Remember, you said any expense which is outstanding or any expense which is owing is an expense not yet paid at the end of the year. This one we said 1, we add it to the expense already paid, and number 2, we account for it as a current liability. We account for that as a current liability. I'm told this one is 250. I'm told that one is 250. Okay, that one is 250. So therefore, no working which is required as far as number 3 is concerned. So those expenses which were owing, we add them to the expenses already paid, to the expenses in the trial balance, and then we treat them as a current liability. Number 4, allowance for doubtful debts amounting to 200,000 is to be made. So what we need to do here is basically to determine whether we have an increase or decrease in allowance for doubtful debts. So number 2, we have allowance for doubtful debts. For doubtful debts, which was created at the end of the year. For doubtful debts. So the ones which was created at the end of the year as per note number 4 is 200,000. Remember, this is a provision at the end. So what we need to do is basically we compare this with the provision at the start, and then we see, do we have an increase or a decrease? So can we go back to the trial balance? You tell me, do we have any provision allowance for doubtful debt in the trial balance? In the trial balance which you're given, do we have any provision or allowance for doubtful debt, Esther? We don't have any. So meaning that at the start of the year, the provision for doubtful debts was 0, but now it is increasing to 200. So meaning that this 200 basically is an increase. And remember, you say that an increase in provision for doubtful debts, an increase in allowance for doubtful debt, that one is what? Is an expense in the income statement. So this one will be accounted for as an expense in the income statement. When preparing the statement of financial position, we will also list this one from receivables. We are done with that. Number 5, insurance paid in advance at the end of the year amounted to 40,000. No working for that, but this insurance paid in advance, we are going to list it from the amount already paid. And number 2, we account for it as a current asset. As a current asset. Number 6, which is the last additional information here. So during the year, which ended 30th of April 2016, the partners withdrew goods from the stock for personal use as follows. Now, these are the goods which were taken by the partners from the partnership business. So these particular drawings by partners, the drawings of goods, and basically which are given in the additional information. In the additional information, it is important for you to note that these particular drawings for goods, they have not yet been accounted for. We said anything which are given in the trial balance has not yet been accounted for. So because if we go back to the trial balance, the last item within the trial balance, we have drawings by Maria and Bakari. Now, these drawings which we have in note number 6, they have not yet been accounted for. They are not part of the drawings given in what? In the trial balance. And therefore, these drawings of goods given in the additional information, which will be total drawings of 150 for Maria, and for Bakari, 590, which basically give us a total of 740. This one will be deducted from the goods available for sale. The goods available for sale. Anytime you go to your business, you take what? You take goods for your personal use. That reduces the goods available for sale. It reduces the goods available for sale. And number 2, these particular drawings, other than being deducted from the goods available for sale, they will also be added to the drawings. They will also be added to the drawings which are given in the trial balance. They will also be added to the drawings given in what? In the trial balance. In the trial balance. So that basically will be the accounting treatment of those particular drawings. So, and I think now having that, we can proceed and basically prepare what is being required there. I want us to start with the part A, preparing the income statement. And we need to have the title. The name of the partnership will be Maria and Bakari. Maria and Bakari partnership. This is the income statement. The income statement, and automatically we have to add the appropriation account. We have to add the appropriation account, and basically this is for the year which ended 30th of April 2016. 30th of April 2016. 30th of April 2016. Yes, so here we need to have two columns. We need to have two columns, and I hope you can also be able to see the figures which are given in the trial balance. They are in thousands of shillings. So in thousands of shillings means that for any figure which is given in the trial balance, the last 3 zeros have been omitted. So therefore, we said for you to be consistent, anytime you're taking a figure from the additional information, you must also omit the last 3 zeros. So let's prepare this. So we start with the sales. The sales. So where do we have the sales? The sales, we have it within the trial balance. Below where we have the renovation of building, which is given as 87,460. So to this, we less the sales return, or basically the return inwards. So we need to check whether we have the sales return. Do we have sales return or return inwards? Do we have sales return or return inwards within our question here? In our trial balance? In our trial balance, I can't see sales return. I can't see any sales return or return inward. So mean that our net sales will be that amount. Then we proceed. We compute the cost of sales, the cost of sales. So the cost of sales, this one is computed in the normal way. We take the opening inventory. The opening inventory, this one, we have it within the trial balance. I can see it up there below current account and capital account. I hope you can see that amount, which is 19,000. So to this, we add purchases. So purchases, that is below our sales, and that is an amount of 62 and 40. 62 and 40. To this, we less purchases returns, or the return inward, the return outwards. And I don't think we have this one. We don't have purchases return or return outwards. To this, we add carriage inwards. And I think we have carriage inwards. So how much is our carriage inwards? Carriage inwards. Is it 960? Yes, carriage inwards, which is 960. 960 there. Yes. So the other item which we also deduct here is something we didn't came across in the topic of sole proprietorship, these drawings of goods. And the drawings for goods which we list here is very, very important for you to note. The drawings for goods, or the drawings of goods, which we list here, should be the drawings for goods which are given as part of the additional information. So these drawings of goods given in the additional information, they have not yet been accounted for, not the drawings within the trial balance. If the drawings in the trial balance were drawings for goods, they have already been deducted from the purchases figure. But what you list here are the drawings for goods given in the additional information. Are we together? Yes, that one you must understand it. You must understand that. So the drawings for goods, we have said is 150 plus this one, which will give us 740. So we list that here. We list that there. And basically now we will get the goods available for what? For sale. We will get the goods available for sale. We will get the goods available for sale. So how much will be our goods available for sale here? What are you getting? 25 units. If Marimu's computation is automatically not correct. Not correct. Yes, what are you getting, guys? What are you getting? We try to hurry up. We must finish this particular question today. 83, 160. 83, 160. So to this, then we proceed. We left the crossing inventory. So the crossing inventory, this one, is given in the additional information number 1. Additional information number 1, 15, 600. 15,600, 15,600, yes. So let's get the cost of sales, which we can take now to the last column. I'm getting 65, 760. Is that what you're getting? Is that what you're getting? Is that what you're getting? Yes. So and then we get the gross profit. We get the gross profit. So the gross profit in our case here will be, I'm getting 21,700. 21,700. That is the figure I'm getting from 𝐻𝐿. That is the figure I'm getting from 𝐻𝐿. That is the figure I'm getting from 𝐻𝐿. From 𝐻𝐿. Okay. So to this, we proceed, we add other incomes. We proceed, we add other incomes. So we need to go back to the trial balance. We see, do we have any other income? And remember, in this case, we said when checking for the other incomes, we check the items on the credit side of the trial balance. That's what you have to recall. So on the credit side of the trial balance, up there, you can see we have capital current, partners capital account, current account. Those are not incomes. Then down there, you can see we have sales. I can see we have bank balance, account payable. Down there, I can see we have accumulated depreciation. It basically means that in our case here, we don't have any other income. We don't have any other income. So we proceed. We get the total incomes, which remain the same as the gross profit. So then to this, we proceed. We less the expenses. We less the expenses. The expenses. Remember here we said when deducting the expenses, we always start with the expenses affected by the additional information. Affected by the additional information. Can we first of all go to the additional information? In the additional information, number 1 is all about the closing inventory. That is not an expense. Number 2, we have these 2 depreciations. We have depreciation on buildings. Depreciation on buildings, which is 250. We also have depreciation on furniture. Depreciation on furniture, which is 245. So 245. So I've written what? I've written, oh, this one should be, you have written 83 instead of 81. This one should be 81,360. That's what I'm told by, yes, I think that one is correct. Okay, thank you, Purity. Okay, so let's move. We are done with additional information number 2. Additional information number 3, it affects 2 expenses. We are told the following expenses were owing, were not yet paid. So we start with the first one, which are salaries and wages. So salaries and wages, we will take the amount from the trial balance, the amount in the trial balance which was already paid, and the salaries and wages from the trial balance, that is an amount of 24. I hope you can see that figure down there. And then to this, I will add the amount which was owing. Amount owing is amount accrued. And remember, in this case, we have said when taking any figure from the additional information, you must omit the last 3 zeros. I'll take that figure as 200, not 200,000. So this will give me 26. So still in note number 3, we have electricity. For electricity, I'll take the amount we have in the trial balance, the amount which was paid and accounted for. And that, I think, is an amount of 500. Should be 500. 500. And then I will add the amount not yet paid as per note number 3, the amount of 90. So that will give us a total of 590. So we are done with the note number 2. Note number 4, sorry, we are done with the note number 3. Note number 4, we have this increase in allowance for doubtful debt. This one, 200. We have increase in allowance for doubtful debts, the amount of 200. That is an expense. Number 5, it is affecting insurance. It affects insurance. And basically, as per note number 5, we are told part of the insurance was prepaid, was paid in advance. So I will take the insurance we have within the trial balance. The insurance we have in the trial balance is an amount of 300. And basically, in this case, I will deduct the amount which was prepaid or paid in advance as per note number 5, which is 40. I will get to what? 260. So then from there, we have note number 6 is about drawings. Those drawings, they are not expenses. They are deducted here. So then from there, we can go back to the trial balance. We check the other expenses which you have not dealt with. And remember, you said when checking for the expenses, you check the items appearing in the debit column of the trial balance. So let's see whether we have the other expenses within the trial balance which you have not dealt with. So up there, we only check the items appearing on the debit column. I can see inventory, building, furniture, renovation. Renovation, we said, is not an expense. It is part of the building. It should be added to the cost of buildings. So then below that, we have purchases. We have dealt with that. Below that, we have rent and lease. Have we dealt with the rent and lease? No. So we have rent and rate. Basically, that will be our other expense, 400. Below that, we have electricity. We have already dealt with that. We have bank balance, account payable, yes, and then account receivable. Below that, we have repair and maintenance. That is basically the other expense, 1320. Below that, we have general expenses. General expenses, which is 47. Below that, we have insurance. We have already dealt with the insurance here. Carriage inwards, we have dealt with that here. Bad debt written off, we have not yet dealt with that. So we have bad debts, which were written off. And basically, that is an amount of 270. Salaries and wages, we have dealt with that here. Office expenses, we have not dealt with that. So that will be the other expense here. And that is an amount of 600. So then below that, we have, remember, I'm only interested with the items appearing on the debit column. I can see we have cash and we have what? We have the drawing. So meaning that we don't have any other expense. I hope we have considered all the expenses. Is there an expense you have skipped, which is given within the trial balance? I don't think so. I don't think so. So let's get to the total expenses. We add all these expenses here. We have 250 plus 245 plus 2600 plus 590 plus 200 plus 260 plus 400 plus 1310, sorry, 1320 plus 4700 plus 270 plus 600. That is giving us 11,435. 435, and then we less that from our total incomes minus 21,700. And then in this case, we get the profit for the year. The profit for the year will be how much? Will be 10,265. 10,265. Is that what you're getting? 10,265. 10,265. Is that what you're getting? Is that what you're getting? Is that what you're getting? Yes. Juma, I've not seen any answer from Juma today. I hope you're together, Juma. Juma, tuko pamoja? I hope so. I hope so. So basically, I've said once we are done or we have gotten this one, the profit for the year, we proceed and prepare appropriation account. So to this, first of all, I've said we add interest on drawings. Interest on drawings. Is there any information we are given about this? Are the partners charged some interest on drawings? So that information has to be given in that, or it can only be part of the paragraph 1. Can we go back to paragraph 1? We see what we are told. We are told Maria and Bakari are in partnership, sharing profit and losses in the ratio of 3/5 for Maria and 2/5 for Bakari. The partnership did provide for the interest on capital at the rate of 5%. The partners are entitled to annual salary of 1,700,000 for Maria and Bakari. There is nowhere we are told the partners are charged interest on drawings. So meaning that we don't have any interest on drawings. And basically the amount which we get here, which is 10,265, this is the amount which is to be distributed to partners in form of salary, in form of share of profit, in form of what? Interest on capital and so on. So therefore to this, what we do, we proceed and we less the appropriations. To this, we proceed and we less the appropriations. So the appropriation in this question, we have how many? 3. We have salary to partners, we have interest on capital, and then we will have the share of profit or share of losses. So we start with we can start with the salary to partners. Salary to partners. Remember, you have 2 partners. We have Maria and basically Bakari. We have Maria and Bakari. And we are given their salaries. In paragraph 1, the last sentence, 1 million for Maria and Bakari, 700. So this 1 million, we take, remember we omit the last 3 zeros. So it will be 1,700, 1,000 of shillings here. We get the total, we take it to the last column as a deduction. Basically, don't underline it. We will deduct that from this amount here. So then below that, we have interest on capital. Interest on capital. So we need to compute the interest on capital for each partner. And this one is computed based on the partners' capital account balances. So we need to compute this one for Maria and basically for Bakari. So as per the information we have in paragraph 1, we are told partners are entitled to interest on capital at the rate of 5%, not 10, 5%. So this should be 5% of what? This one should be 5% of the partners' capital account balances. The partner capital account balances, this is the first item we are given in the trial balance. The capital account balance for Maria is 12,000 and for Bakari is what? Is 5,000. So we get 5% of this. 5% of that. 5% of 12,000. This one will be 600. And this one will be what? Is it 250? Yes, 250. So we get the total. We take it to the last column as 850. The last appropriation here will be the share of profit or share of loss. How do we determine whether we have a share of profit or a share of loss? So what we do, we take the amount which we have here, we less this and this. So if you get a positive figure, is a profit to be shared. If you get a negative figure, is a loss to be shared. Automatically, in our case, we will have a positive figure. So which would be a share of profit. Which will be a share of a profit, a share of profit. So let's determine the amount to be shared as profit. And this profit will be shared between Maria and Bakari. Maria and Bakari. Remember, you're given their profit and loss sharing ratio in the first paragraph, which is 3/5 for Maria and 2/5 for Bakari. So we multiply that with the amount to be shared. The amount to be shared, how much have you gotten? This minus those two appropriations, 10,265 minus 1,700 minus 850. So that is the amount I'm getting. That is the amount I'm getting. That is the amount I'm getting. Is that what you're getting? 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 Yes, that is confirmed by Esther Eunice. And I've not seen any answer today from Nicole. Is Nicole here? I'm a reporter. Nicole, I've not seen any answer from you today. I've not seen any answer from you. I hope you're together. I hope you're together. Okay. I've not seen any answer from you today. So let's get the amount to be shared here. The amount to be shared. Paul, you're getting what? Paul, I think your answer is wrong. Please confirm. Please confirm. Reconfirm your answer. So we get the amount to be shared, 7715 divided by 5 times 3, which will give us 4629 and 3086. So that is basically what I'm getting. And the total amount, we take it to the last column. We take it to the last column. Then once we take this, minus this, minus this, minus that, that should be 0. That should be 0 because this amount has been distributed to partners in form of salary, in form of interest on capital, in form of salary. In form of salary. Paul, what are you getting? What are you saying? 5% of what? Where are you getting 1,200? This one is 12,000, Paul. This one is 12,000. The first item within the trial balance is not 1,200. Should be 12,000. Yes. So basically that is it. That what is required in part A of that question. Basically by doing that, the marks allocated here are basically 12 marks. So the marks allocated there were 12 what? 12 marks. 12 marks. So now I want us to move to part B, but even before we do that, here, no, Erin is asking, do partners pay profit? No, partnership business, this is something you'll be able to discuss in details in a unit called PFT, Public Finance and Taxation. A partnership business is not recognized as a legal entity. Partnership is not recognized as a legal entity like a company. A company is recognized as a legal entity. That's why we say a company has to pay tax. So what happens is that this profit, which is reported by partnership, is distributed to partners. Now, it is the partners themselves who are taxed. If you are a partner, you are the one to pay tax to the government based on the amount you have gotten from the partnership business. But the partnership business itself is not a legal entity. It should not pay tax to the government. Salsa? Yes. So basically that is the position. Partnership business is not a legal entity, is not required to pay tax to the government. The partners themselves are the one who pay the tax, and that is something you'll be able to cover in tax in a unit called PFT. You'll be able to see how do we compute the tax to be paid by each partner here. Now, I'm saying before you prepare what is required in part B, there is something which the examiner will not tell you, but you have to prepare the partner's current account even before you proceed to prepare the statement of financial position. Remember, you have said the balance in the capital account will not change unless there was additional capital. So the balance in the partner's capital account will not change. What will change is the current account balances, because all these items here will affect the current account. So we must prepare the current account, and then finally we prepare the statement of financial position. So let's first of all, we prepare the current account, and then we prepare what is required in part B of that question. So we prepare the partner's current account, a partner's current account. So remember, in this case, we have two partners. We just need to have the details column. And basically, columns equal to the number of partners who are basically 2. So remember, this basically ledger account. We must split this into 2. So this will be the details. And then we have Maria. We have Bakari. Details. Maria. And who? And Bakari. And Bakari. So what do we start with here? We always start by recording the opening balances from the trial balance. So let's go back to the trial balance. We pick the balances which are given there. And in that case, we have said you have to be very, very keen. You check whether those balances given in the trial balance, are they debit or credit? So, and those balances, that should be our second item within the trial balance. Below the capital account, we have the current account. And I hope you can see those current accounts. The current account for Maria and Bakari, both, or basically those accounts had credit balances. Credit balances simply because those particular balances are on the credit side. The last column of the trial balance, which is basically a credit balance. So the balance brought down for Maria is 3,000. And then for Bakari is what? Is 1,000. Then you have to record. What do we then record here? On this side, I've said we record all appropriations. All these appropriations, we record them on this side, unless we have a share of loss. If we have a share of loss, that should come to this side. So we have salary to partners, which is 1,000 and basically 700. We have the interest on capital, which is 600 and 250. We have the share of profit, which is 46.29 and 30.86, like that. So all those appropriations should be credited here, unless we have a share of loss. So on this side, then we have drawings. The drawings, we will take the drawings which are given in the trial balance. And the drawings, that should be the last item within the trial balance. But remember, the drawings for goods which are given in the additional information number 6. The drawings for goods given in the additional information number 6, we see those drawings have not been accounted for. Other than deducting them from the goods available for sale, we will also add them to the drawings given within the trial balance. So the total drawings for Maria will be the amount given in the trial balance 28 plus the drawings in note number 6 for Maria. So it is 28 plus 150, 2,800 plus 150, which will give us 2,950. That is for Maria. For Bakari, the drawings given in the trial balance 2,000 plus the ones which are given in note number 6, which is 590. So that will give us 2,590. Yes. So the other item, which is also recorded on this side, and basically in this question we don't have it, is the interest on drawings. So the other item which is also recorded on this side is the share of loss. So we don't have share of loss. So basically having that, then what do we need to do? We need to balance this account. This account here. This account. And remember this basically a ledger account. This is a ledger account. So to balance this, we use the same concept we were using in balancing the ledger account. Only that here we have two current account for Maria and for Bakari. So we have to balance for Maria. We get the total on this side, which is 2950 for Maria first of all, and then we get the total on this side for Maria. Yes. So the total on this side for Maria, this one will be 4,046. 46 plus what we have here, 4629. So the total on this side is 9229. So what do we record here in the totals? The amount which is more, which is this one. And we record it on both sides. 9229, 9229. So we know that if you add all this, it will give us that amount. But if we add all this, will it give us this amount? No. So it will give us this. So what is the difference? The difference we record it here as a balance carried down. So this minus this one. So which is 6279. So we do the same for Bakari. Get the total on this side. These drawings are correct. Or the drawings for the two partners are actually the same. These are, oh, sorry, they are not the same. They are, this 2950, this 2590. Okay, it's okay. So this will give us 2590. What about the total on this side? This will be 17 plus 250 plus 86. 86, this one. So that will give us 50, 36. So the total which is more is this one, 50, 36. 50, 36. We record it there and here. We know this will give us that, but this will not give us this. So what is the difference between these two values? 2590. 2446. 2446. Is that what you're getting? Yes. That is basically what you're getting. Yes. So now I wanted we wind up. Let's wind up by preparing what is required in part B. The statement of financial position as that a statement of financial position as that 30th of April 2016. 30th of April 2016. 30th of April 2016. 30th of April 2016. So here we just need to have a single column. And what do we start with? We start with the non-current assets. We start with the non-current asset here. Non-current assets. So for the non-current assets, basically we have a number of them. We have a number of them. The first non-current asset is which one? Purity. Is which one the first non-current asset? The first non-current asset is which one? Purity. Yes, I'm told by Zuma. I'm told by Zuma is what? Is buildings. So buildings. So for buildings, remember, we will take the cost of buildings, which is 85, but also to this we said we add the cost of renovation. the renovation cost is also added here. Is also added here. Sasa? Yes. So we also add the renovation cost here. And then remember, you say to compute the net book value of the asset at the end, we should less the accumulated depreciation at the start. If you check on the information given in the trial balance, there was no accumulated depreciation for buildings at the start. No accumulated depreciation for buildings at the start. So to this, we will only deduct the depreciation for the current year, which we computed here, which is 250. So we don't have any depreciation, accumulated depreciation at the start. This will be 10,000 minus this one, which will give us 97.50. So below buildings, we have furniture. We have furniture. So we take the cost, which is 32. We left the accumulated depreciation at the start. I hope you can see that almost at the bottom of the trial balance, the provision for depreciation, 750. And then we also left the depreciation for the current year, this one, which will give us, which is 245, which is 245. That will give us what? I'm told that will give us 2205. 2205. Okay. So below furniture, or in this case, do we have any other non-current asset? Any other non-current asset? I can't see any. We have any other? No. So we move and record the current assets. The current assets. So for the current assets, I think we can first of all pick what we have in the additional information. In the additional information number one, what do we have? In the additional information number one, we have the closing inventory. We have the closing inventory in the additional information number one, which is 15,600. Then below number two, we have the depreciation. That has nothing to do with this. Note number three is expenses which were accrued. That will be current liability. Number four, allowance for doubtful debts. That will affect the account receivables or the trade receivables. So in the trial balance, we have account receivables. So the account receivables in the trial balance is an amount of 5660. And then to this, we said we always raise the allowance for doubtful debts at the end, which is 200, which will give us 50 forward 60. So number five, we have insurance paid in advance. Any prepaid expense is basically a current asset. Insurance paid in advance. So the insurance paid in advance is basically 40. Is 40. So then note number six, that is not a current asset. So we go back to the trial balance and remember when checking for asset, we check the items appearing on the debit column. So can we check whether we have any other current asset? Maybe we can start with the last item in the trial balance. We have drawings, basically which is not an asset, but above that we have the cash balance. The cash balance is an asset, which is 230. And then above that we have office salary, budget written off, carried in what? Insurance, general expenses, repair and maintenance, account receivable. We have already dealt with that one. Then up there, you can see we have electricity, rent and rates, purchases, renovation, furniture, buildings. Yes. So in our case, we don't have any other current assets. So what we need to do is we get the total assets. We get the total assets. Give me the total assets. Give me the total assets. Give me the total assets, the total assets, the total assets. Just a minute. Okay, so let's finish on this. Maybe I hope you have already done. You already have the final figure. So I'm told this one will be 33 to 85. So then with the borderline start, we proceed. In this case, I've said in case of partnership. So we start by recording the partners' capital account balances. So partners' capital account balances. And basically, these balances is what we have in the trial balance, the first item. In the trial balance, the first item, we are given the partners' capital account balances for Maria and basically for Bakari. And those balances we have said, in this case, they are not changing. But I've said, for those who are doing admission, retirement, you'll be able to see that we have some adjustment which we make in the partners' capital account. So this one is 12,000. And then for Bakari is 5,000. Then from there, we record the partners' current account balances. Partners' current account balances. And the balances which we record here for the current account are not the ones which we have in the trial balance, are these closing balances. That's why he said, even before you prepare this one, you must prepare this account because you need to get the new balances. The new what? Balances. In this case, it's also important for you to determine these particular balances here. Are they debit or the credit? Are they debit or credit balances? Now, who can tell me these balances for the current account, are they debit or are they credit? So the balances from the partners current account, are these debit or credit balances? Eunice, Purity, Rin, or are these debit or credit balances? Yes, remember when we were looking on the topic of ledger account, I said if you get such a question, you give the balance brought down. So remember in this case, the balance brought down should be on this side, should be on that what side. So these are credit balances. So if they are credit balances, you record them here as positives. If they are debit balances, you record them here as a negative. So these are credit balances for Maria. And basically for who? For Bakari. So we have 62.79. We have 24.46. Yes. So then from there we proceed and record liabilities. We start with the non-current liabilities. Non-current liabilities. Non-current liabilities. So for the non-current liabilities, I don't think we have any because we said in a partnership business and also in sole proprietorship, non-current liabilities may only take the form of a bank loan. We don't have a bank loan here. Finally, we record the current liabilities. We record the current liabilities. The current liabilities. The current liabilities, we have a number of them. Maybe we go to the additional information first of all. In the additional information number 3, we have some accrued expenses. We have accrued salaries and wages, accrued salaries and wages, and also we have accrued electricity. Any expense not yet paid, we say it is a current liability. Other than being added to the expenses already paid, we also account for them as current liabilities. We have 200, and then we have 90. Then number 4 is allowance. Number 5, we have dealt with that. Number 6, we have dealt with that. So we go back to the trial balance. And basically, remember, all liabilities, they have a credit balance. Check the items appearing on the last column. So up here, we have the capital, the current. And then down there, I can see we have sales. Then I can see we have bank balance. Can you see the bank balance of 1070 on the credit side? So which name is given to that amount? That bank balance of 1070, which is on the credit side. Yes, this one I can see, Eunice, you can be able to remember that. We say that this one is known as a bank overdraft. Is known as a bank overdraft. But we say the examiner will not tell you. He will just give you that balance, but he give that balance he recorded on the credit side is a bank overdraft. So 1070, And then below that, we have the account payables. Account payables is the 62. And then down there, you can see we have provision for depreciation. So basically, in our case, we are done. So what we need to do here is we get total capital and liabilities. Total capital and liabilities, we add all this. We add all that. We see whether it will give us the same amount there. Will it give us the same amount? Yes, I'm told by Zuma it will give us the same amount, 33, 285, 285, 285, 285. Yes, so it's basically coming to the same amount. So that's basically how we prepare the financial statement, or basically the final account of a partnership. But basically, I've said that if you check on those particular questions specifically tested in CPA and ATD2, you'll be able to see that most of the questions do not examine on this. There are questions having the aspect of admission of a new partner, a retirement of a new partner, or even a question for dissolution of partnership. So mean that for those who are doing ATD and also for those who are doing ATD2 and CPA, we will be able to proceed and look on how do we account for admission of a new partner, how do we account for retirement of a partner, how do we account for admission. But basically for those who are doing ATD1 and CAMS, I'll be able to give you more work on this, more assignments on this. So mean that you'll not be required to attend like the next two classes, but I'll be able to see whether I'll be able to give you an extra class for those who are doing CPA and ATD2, because preferably I want us to finish on this topic this week. So if we can be able to get like 2 classes, we should be able to finish. 2 or 3 classes I'll be able to see. We should be able to finish with this, so that now we can be able to proceed to another topic. And also what is insisted on as far as financial accounting is concerned, you need to do a lot of exercise. A lot of exercise. Once we are done with a certain topic, try to go through the past papers and you see, are there some other questions which you can be able to attempt? Because you can only become perfect in this paper here, financial accounting, by doing a lot of exercise, by practicing a lot. Yes. So for today, therefore, I want us to stop on at that point and be able to communicate maybe with those who are doing ATD2 and basically CPA. We see whether we can be able to create maybe one additional class in course of the week, so that we can be able to discuss the remaining aspect. But I've said those who are doing ATD1 and basically comes Akina Esther, I'll be able to give you more work on this. You're not required to cover the aspect of retirement, admission, and dissolution. So I think, Rin, can you remind me tomorrow whether we can be able to create time so that we can have an extra class? Rin, Sasa? Yes. So let's stop at that point for today. We continue from there in our next session. So have a good night.